All right, people are coming in to today's webinar, so we'll give it just a second for everyone to get loaded in. I see the ticker ticking, so we'll just give it another second for everyone to get into today's Association Essentials series. All right, good afternoon to most of the country. Still morning in the west side of things, but welcome. My name is Michael Johnson. I'm CEO of the HOA Living Companies, and I am proud to be your presenter today on Association Insurance 101. And this is something we do on a regular basis, and just to update things and to keep it going. We have a lot of great things. You saw the slide on our to find old recordings, and you're going to see some mentions of it. We spent a couple years ago, we went into each of the different components of association risk management, the type of exposures, and the coverages in great detail. And we'll probably do that again next year, but you can go and find those at the HOALiving.com website under board member tools and education, and look for the AES links. Also on our YouTube channel. All right. Oh, and that's just a little preview also in there for our last event of 2023 on November 15th. We're talking about working with business partners, vendors, the RFP process, and all those great things. Some of the great people from the HOA Living staff. Let's talk about managing risk. That's what we're here to talk about today. Insurance, we call it Insurance 101 because that's the hook that gets people in. But really, insurance is a type of way to deal with the risk that we have in our associations. So risk management really is what all of us should be about on boards for our associations, as management of boards. And what is risk management, right? It's the process of making and carrying out decisions that will minimize the adverse effects of accidental losses upon a community association, right? None of us are out there managing or leading our communities, purposefully creating scenarios where we're increasing risk. That's not a thing any of us are doing or involved in. We're trying to minimize that. And risk management procedures that we'll talk about today are going to help us get there. So let's understand risk exposure, and then we'll go into ways we can cover those exposures. Remember, we got a lot of fours in the risk management and insurance topic. We have 4 types of exposures that we're concerned with. Property exposures, liability exposures, income exposures, and personnel exposures. What are they? Let's look at them individually. Property exposures are the ones that, one, super expensive. Two, this is what we think about the most, is our association owns the buildings that our members live in, and so we have to ensure that. Or we own a beautiful amenity, a clubhouse with fitness rooms and swimming facilities and meeting space and kitchens and the like. Maybe libraries or game rooms, all kinds of things. So property exposures are, right, those tangible properties, those buildings, but also the contents. We might have, if you have even a small gym, you're looking at $100,000 worth of equipment in that gym. Or you might just have couches and furniture and pool tables. You might have an office with desks, computers, those kind of things. Intangible property is also an exposure, is what information's on that computer. Are all of our owner accounts, history, the financial history association in there? And then our websites and things like that are also considered intangible property that have a value, that have exposure. You can be hacked, cyber crimes, all those things that we need to be aware of. And obviously, right, property exposure, the big fire in a community, always a big fear. But we also have natural disasters such as forest fires, wildfires, hurricanes, those kind of things, or even the horrible tragedy in Florida and the Surfside Tower collapse, all, right, a property exposure. We can buy insurance. So there's things, right? What are the coverages? What are things we can do to prevent this fire? Well, we can make sure that we have working fire alarms. If we're in a building that, when it was built, has a fire suppression sprinkler system, we can make sure that's working properly. We cannot store extra cans of gasoline next to the building's furnace. There are lots of things we can do. If we notice that sidewalk concrete is not level, can we grind it down or replace it? Can we trim back trees? If we're in an area that is subject to wildfires, can we create a clearing around the property, around the buildings? So there are a lot of things we can do that aren't necessarily buy insurance. But even as good as we do those things, and just the sheer dollar amount of having to repair if a property exposure happens, we need to have insurance. And the insurances that we can buy for property coverage, that property exposure, are the following. A commercial package policy, that's the property insurance policy that covers us for all the multiple different perils. There's hundreds of pages of exemptions and exceptions, and we don't cover, but this is the core policy, a CPP for our associations. We can also buy, and we also need to buy, additional insurances because they're excluded from the commercial package policy, such as mechanical equipment and breakdown insurance. If we have a boiler, if we have a elevator, if we have equipment, when the building burns down, the insurance, the CPP, will rebuild the building, but it's not going to rebuild the equipment. You have to have a separate policy. Ordinance law insurance. This is insurance that covers us, that if the zoning or the the building standards have changed. The ordinances have changed since the building was built. So say you're a 3-story building, and in 1982, when the building was built, you were not required to have a fire suppression system. But now when you pull a permit to build such a building in your jurisdiction, you have to put in fire suppression system. The CPP insurance is not going to build something that wasn't there before. It's going to return what you had. And so now you got a problem. You have a $10 million building to build, and it's $450,000 for a sprinkler system, fire suppression system. And that's required now. If you don't have ordinance law insurance, the association's going to have to come up with those funds to put that system in outside, because the CPP policy is not going to put something in there that wasn't there before. So that's ordinance law insurance. Electronic data processing covers some of that information that is inside of our computers, inside of our servers. And then flood insurance, right, is excluded out of the normal perils. And there's a flood insurance program in the United States. And you're rated, you're in a flood zone, not in a flood zone, you have to have it, you don't have to have it. So these are different types of property coverages that you can buy to handle the property exposure. CPP obviously is the most expensive. Your mechanical equipment, ordinance law, EDP are much cheaper policies, and flood insurance can be pricey depending on the rating of where you are, and something that you're going to have. We have a detailed at the website, a detailed full hour presentation on just property coverages, and we invite you to go to the website and watch that if you want more information. The big thing to talk about is property coverage and insurance rates for this particular type of insurance have gone off the rails this year. Property coverage has gone more than triple in some parts of the United States. Some of the lowest are actually in states like Utah that we do business in, is about 36% is the average increase. But we're seeing as an industry, we're seeing in Florida, California, some up to 300% increases. So that means if you had a $300,000 premium per year, and obviously that's going to be a high-rise type of product or mid-rise, you're looking at $1 million for insurance this year. And it's really came out of nowhere. It came fast. It came from all the natural disasters insurance is paying for. We're also seeing they might not be increasing your rates. They might just be dropping you. And we've seen even in all of our places that we have management companies, we have seen insurance carriers or whole insurance carriers that have been writing insurance in a state for years pull out and are no longer going to service a market. And that's caused us to have to go to a secondary market, or less competitors means increased prices. And so insurance costs for this property coverage have gone way up this year, just industry standards. There's a QR code there for the CI webinar that's available on demand called Navigating Insurance Going Beyond the Noise in Today's Hard Market. $99 for non-members, $69, I believe, for those of you that are members, like most of our clients are. So if you're interested, there's a QR code to see that seminar. It's an ongoing topic, and we're, the industry, the insurance industry just kind of put their arms up and said, hey, we've paid out trillions of dollars of claims these last few years. So, right, identifying exposures and doing exposure coverage that you can do outside of insurance is really going to help you. Also, right, when you have property coverage, don't file all those little claims, because the rates will increase for your community based on the number of claims, not the amount paid off. I've had insurance agents tell me that $1 million fire claim, and they only claim association, will affect ongoing rates less than 3 or 4 $10,000 water claims. So we really want to minimize the quantity of claims made. Obviously, we don't want big claims at all, but we don't want to be sending through every single little claim. We'll talk about how associations are handling that a little bit. So our second of our 4 exposures are the liability exposures. And like the subtitle says, coverage for bad things that happen to other people because of you or your property. So if you have a giant pothole in your parking area, common area parking area, and a car goes through, hits that pothole hard, it damages their car, and it also caused the car to veer off the road and take out a awning over covered parking spaces or something. That's a liability exposure, that property damage to repair that car and the awning over the covered parking is going to come from a liability type of insurance, not the property insurance. Bodily injury, right? If someone gets injured, this is the person who doesn't read the do not dive into the pool signs and dives into the shallow end anyways, getting hurt. A personal injury is somehow a copy of the delinquency report got sent out to all the owners and my account is listed. I'm past due 6 months. I've been sent to the attorney, and now everyone in the community knows I've been harmed in some way. That'd be a personal injury. And then an advertising injury, if you have websites or community email blasts, the bigger communities that still have a publication, a newsletter, or magazine of some sort, and I put false information about an ad. I own a sandwich shop, and the deal was buy one, get one free on Tuesdays. And you put in that it's every day. You forget to put Tuesdays in the ad, and then you send it out, and now all these people are coming to my business every day. That could be an advertising type of injury. So and then obviously slip and falls, things like that. The insurances that cover us and that are standard, and even if an association has no property coverage, all of our clients get CGL insurances, commercial general liability, to cover those 4 exposures. But you also need hired and non-owned automobile liability insurance, because if you're a board member, say you're the chair of we got Halloween coming up. A lot of communities are doing trunk or treat activities for the kids in their communities. And I'm a volunteer in charge of the activity. I'm driving to Costco to buy all the supplies, and I hit somebody. It's my fault. Then they find out you're talking on the side of the road. Like, I was just trying to go to Costco for my homeowners association. Well, now you're not driving as an individual, you're driving as a volunteer of the association. And so hired and non-owned automobile covers any vehicles owned by the association, obviously being driven, which most associations don't have vehicles, but also the vehicles of the owners, of the volunteers in the community, including board members. If I put a percentage of our 500 plus clients that have this, 10% maybe. A lot of people are taking the risk. It's not like you're putting a sign on the side of your car, a magnet saying XYZ Association board volunteer, and so people don't necessarily know. But talk to your insurance agent about it, because it's not covered if it's in a vehicle, it's not covered in a CGL policy. It's excluded. Commercial umbrella liability insurance. Umbrella policies are pretty inexpensive, and they double a lot of your coverages on your primary policies, because if you have a $2 million limit to pay out on your liability policy, and you get sued, maybe someone drowns or something horrible, and they get $3 million, then you've tapped out your first CGL policy. The umbrella doubled it to $4 million and can take care of that. And then obviously super important are D&O policies. I would never serve on any nonprofit of any association without there being a D&O liability policy. This is the insurance that protects you when the association and you are sued for decisions that you make. And so D&O, and there's two kinds, and we talk about it. There's the videos from, we have one whole series on directors and officers insurance, one whole broadcast, and one on understanding CGL in general. Two types of policies: standalone and embedded. Embedded is part of the CGL policy, and you get some coverage, but it's minimal. It might only be, now someone sues the association just to make you start enforcing the rule. They don't want any money. They want to just make you start enforcing the rule against Barbie pink doors. And so they sue the association to make you start enforcing that rule. That's not a monetary. An embedded D&O policy will not cover the cost of your legal defense for that kind of a lawsuit. A standalone policy, which is more expensive, covers legal defense of non-monetary claims, which is what a lot of D&O policies are. The third type, and a lot less common, is income exposures. So is there some reason that your association might have an income exposure? Now, your assessments are sent to your management company or to the bank, and we hope everyone gets on electronic payment methods, of course. But if you're taking them in a clubhouse or something, and this is the reason why a lot of associations, they used to have a mailbox that people could drop their payments into on the property. We've pretty much gotten rid of those because of this income exposure and the risk of theft. And so when we're doing our minimalization of our exposures and our risk, it's getting rid of those kind of drop boxes. Or do we have locks on the doors to our offices? Those kind of things. The rare thing, right, are our communities or any communities that make significant income from renting facilities. So if you have a big ballroom or meeting space and you rent that out for weddings and meetings and dinners and things like that, and there's a fire, and so now you're replacing, the property insurance is rebuilding, but that takes 4 months to happen, and you had 20 events at $1,000 a night booked in that space. That's going to be a $20,000 of income now not coming in. So you can buy insurance to protect you. Also, say the association manager's office is attached to that ballroom in that clubhouse facility, and now the office has been destroyed. What are you doing with your staff? Well, you bring in a mobile office, you put it in the parking lot, they work out of there for a little while. And so these are all you can buy, you can do, right? Obviously, your exposure of losing income or having additional costs are very similar to the protections you can do for property insurance, but you can also buy specialized income coverage. So we don't, very few, handful of communities that make enough money to warrant this kind of coverage, but it's also very inexpensive. This assessment fees receivable insurance is not Joe owner stop paying us, we're filing a claim, the insurance is going to pay us their assessments. This is more for a catastrophic event. So the catastrophic event in Florida, the tower falls, all those units, there's still other common area in that community that didn't get destroyed, but do you think 100 units that are no longer there are going to want to be paying their assessments? So there is that kind of coverage. And then extra expense insurance is we have an office or a restaurant or a golf clubhouse that makes that has offices, and if we lost access to that office, where are we going to put them? Whether that's the remote portable office put in the parking lot, or you have to rent space down the block, there is insurance that will cover you. Our fourth type are primarily, our fourth exposure is primarily for our communities that have employees that are employees of the association. So this is claims of employees, right? And so you know them as typically like a workers' comp claim or employer's liability claim. And so, right, if we're going to have a employer's liability, let's talk about that. What kind of things can you do? What kind of risk management can you do to avoid making a claim? Well, you have a non-discrimination policy, you have an employee handbook, you have things in place, you have a no tolerance, automatic termination for breaching a harassment policy. But you can buy insurance, right, for employer's liability. So if the association gets sued because something happened, you can have coverage. That's an employer-employee relationship. Workers' compensation insurance, right, covers the employee when they get injured, gives them wages for the days missed, pays for their medical to remedy whatever injury they have. The biggest question we get is, well, what about volunteers? And we have volunteers who hang decorations or change light bulbs or, go in the pool pump room where there's chlorine and gases in there. You can buy in most states, not all states, and remember workers' compensation and all insurance we'll talk about are very state specific. You can buy policies that cover volunteers. And so if someone is setting up for the trunk or treat, slips while being a volunteer of the association, technically they could be considered an employee, a non-paid employee. And so there is workers' compensation insurance that you can buy for those situations for volunteers. So talk to your insurance agent, talk to your community manager. So if you are professionally managed by one of our companies or another company, what is management doing for you when it comes to risk management in insurance? And our job as managers is to advise the board in implementing financial responsibility by selecting and purchasing insurance. And so we're advisors. We're not the doers. We're advisors. We'll hook you up with the experts in the issue, in the insurance issues. What we will do for you, right, is we have 24/7 emergency reporting, so that when the water damage is happening, you can get a hold of someone at 2 a.m. We can get someone out there, and we can get them to start to at least shut off the water to minimize the effect of the claim. And then we reach out to board members on more large claims, right? We're going to send out an email or a group text to the board, and we may have to, depending on the circumstance, the time, we're going to have authority via our contract with you to do emergency expenditures, even if it's not in the traditional amount of money that management's allowed to spend without board permission. Always for health, safety, life, and property value, we're gonna err on the side of just getting it done. We'll update you as soon as we can, but we don't have time to wait for you to have a meeting or to agree. We just got to get the people out there and get the job done. So the insurance provider is a very important part of all this, because they're the expert. And as a young community manager 25 years ago, and even till today, I would say that insurance is the most complex of all the things that are on a manager's plate, and therefore on a board's plate. So get the right agent and broker who can walk you and us through the process. And it's not your friend who covers your automobile. It is someone who is specialized in the community association world, has significant experience in this kind of insurance, and they know about associations. You also want to know how well they handle claims, and do they participate in CAI or other insurance industry related trade organizations. Obviously, are they licensed? Are they bonded? Do they have errors and omissions, just like management or your attorney or your doctor has? And that CIRMS. CIRMS is Certified Insurance and Risk Management Specialist. So just like you see on my nameplate there on the screen, I have the PCAM and the AMS and the CMCA designations. The designation through the Community Association Institute for the very cream of the crop, top level, experienced and knowledgeable insurance agents in this field is the CIRMS, Certified Insurance and Risk Management Specialist. And we always are driving our clients to someone with one of these certifications. Don't forget, we're talking, we always transition over to buying insurance, but risk management is also all those things that we can do to make sure we never have claims in our communities. So this is where this part's not confusing. This is where the board and management can work together and identify those areas in the community that might be a little risky. It's the same reason that most clients don't allow alcohol in their parties in the clubhouse or at the pool, right? Because that increases risk. So that's a form of risk management to not allow alcohol in events held in community association common area. Now, communities do it, and there's special insurance you can buy for those kind of events. Typically, the association policy is that the owner member making the reservation is the one who's going to buy that policy and indemnify the association from the risk. So being proactive is a big part of it. Plan now and be prepared. What are you in charge of? Reviewing and understanding the governing documents. Read all those pages of fine print on the insurance policies so you understand exactly what's covered and not covered. And then be proactive, developing maintenance charts and plan, develop an insurance chart, adopt a water leak policy. So homeowner, if you start getting water in your unit from the roof or from a neighboring unit or from the grounds, here's what you need to do immediately. Do you need to amend your documents to fix the water leak liability that might be in your community? We have a maintenance company arm that can come out and do a lot of the review of your community property, see what some of the risks are, and help you get them fixed if it's a physical issue. And your manager can set you on resources for the things under being proactive. Annually, the board or someone, a volunteer, should review the insurance. And where do we find insurance requirements? Well, laws, right? Federal, state, local, case laws. Obviously, like I mentioned, insurance laws are very nuanced to state by state. So what's going on in Minnesota is different than what's going on in Utah, is different than what's going on in Louisiana, is different than going on in California. So you got to know what those are. Your association governing documents, and we'll look at some examples in a minute, is going to have very specific language on insurance and the requirements of the association to provide. The secondary mortgage market, Fannie Mae, Freddie Mac, VA, and the lender requirements, there's certain things that they require. Most of them require 100% replacement cost. So you can't just take a risk and say, we're going to cover 70% of the building's total cost. We're going to take an edge on whether or not the whole thing would be destroyed. Can't do that. Most of the time they want 100%. Contractual obligations, right? So if you have a contract with a business partner, with a facility, they're going to have requirements. And then just simply the good business judgment rule. We have seminars on business judgment rule and board responsibilities. Says, okay, we need to have insurance as one of our risk management exposure techniques. So remember our hierarchy of authority: the higher the position, the greater the authority. And so laws and statutes are right up there at the top. When reviewing the policy, we're going to look at who's insured, what's the time period involved. Because remember, insurance policies are 1-year documents, 2 and 3 years are sometimes available. What exactly is insured? What's caused? And what are things are not covered, what's excluded, and what are the limits. There might be dollar limits or time or amount of claim limits. So reviewing your governing documents, very important part of the process to look at your CC&Rs, right? It's on that hierarchy of authority, and this is where you're going to find. I haven't seen insurance requirements and articles of incorporation other than indemnification and coverage of the board and volunteers. Sometimes see that in bylaws, but the crux of the insurance requirements are going to be in your declaration or CC&Rs. You'll see entire sections that say insurance. That's a section in your annual review you want to go read and highlight. So in this insurance page of this association, one thing I want to point out here is there's the word shall and the word may. So shall means you have to do it. You don't have a choice. May says you may do it. And so know when you're reading through and highlighting, underline the words shall and may, right? The board shall obtain insurance. The association shall maintain a blanket policy of property insurance covering all the common areas and all the buildings, fixtures, equipment. The blanket policy shall be an all-in or all-inclusive, and you're also going to cover the fixtures, the improvements, and the betterments. At a minimum, the blanket policy shall afford protection against the following types of perils: fire, windstorm, hail, riot, aircraft, vehicles, vandalism, smoke, theft, and all perils normally covered by a special form property coverage, which is an insurance term. This document says you will cover 100% of current replacement cost, and you'll have a current replacement cost endorsement, talks about that. Then look at the bottom there. This association shall keep an amount equal to the deductible or $10,000, whichever is less, in an account, in a savings account. So insurance is great, and one thing we're doing to control costs is we're raising what the deductibles are, and so to be able to afford them, we increase that deductible. And so a lot of communities might want to look at their language, because you might be tied and might need to do an amendment. But if you're an association that lives on the edge financially and you have a insurance claim, you got to have that deductible somewhere to be able to get the coverage that you need. Association's policy will be primary. The board can use the business judgment rule. Association has to provide notice of changes in the deductible before it happens. And this talks, number 9, the association shall have no obligation to cover what is the owner's personal property inside, personal and real property that is theirs, not part of the building. This says, right, that you'll have a CGL policy, shall, and it won't be less than $1 million of coverage. You shall have directors and officers insurance. Now look, theft and embezzlement insurance. The association may obtain for theft of board members, officers, employees, manager, and contractors. But there will be your mortgage, Fannie Mae, Freddie Mac, has a requirement that you shall have theft and embezzlement insurance. So even though this document gives the board the option, unless you live in a community that has no federally funded mortgage backing, you're going to have it. Workers' compensation shall purchase for all employees. If you have no employees, then it's an option. So here's another example. It's embedded. It's not its own section. It's embedded in the general articles. This is kind of language you see, right? There's different levels of insurance, company ratings of coverage. This one, you shall have one that's rated A or better, and it tells you where those ratings are. The board has the right and authority to adjust losses. The board shall be required to use reasonable efforts to secure insurance policies that provide the following. There's a may not be in there in 6.4.1. Another shall, another shall, another shall, another shall. So look at those wordings. 6.4.8 says shall give notice to the owners at least 30 days prior to a change. Owners may not, there's a may not, and your insurance 6.410 at the bottom shall be consistent with the provisions of the act or the state or the laws where you're located. Insurance will be part of the base assessment. That's pretty common language. The deductible for claims shall be paid by the owner who would be liable for loss. And this here is the deductible shall not exceed $5,000 unless 30 days notice is mailed to all the owners. And a lot of time the insurance agents will send those notices to all the members of the association. For our managers that are watching, sometimes there's some grammar errors or formatting errors. So ask the insurance agent to send you what they're going to send to all your homeowners beforehand, so you can help proofread that for them and make sure the deductible and those things are right. Earthquake and flood insurance we get asked about quite a bit, and this has the word shall in this document, but shall have the right, but not the obligation to get earthquake and flood insurance. But if 2/3 of all the owners demand it, then they have to. So earthquake insurance, it's expensive. The deductible is generally a percentage of the claim, like 10%, 20%, 25% of the total claim, not a flat $25,000 or $50,000. And so that's why I would say 20% of associations cover it, and others decide not to. It's a cost issue, and I get it. Depends on where you're located. Is there fault lines? If it's in California, I for sure would not live in a community without earthquake insurance. Questions and answers. That's the end of my presentation for today. And hopefully it's been helpful for you and giving you some things to think about. Mr. Neal, do we have any questions that have been submitted in writing or people?
Yeah, nothing outstanding, but there was a question I do think bears a little bit of a comment. The deductible for property coverage. Work with your insurance agent really closely on that, because that does vary so much from market to market. Age of buildings, loss history, all of those things are going to play a big role in what you decide to be that deductible as your board, and of course weighing all of those together.
Yeah, and we've really seen them go up, Neil, haven't we, in the last couple of years now, where common was $10,000, I would say, in most of our areas. Now it's going up to 25 or 50,000, which means association, if it's for your common area, you need to have $50,000 somewhere to pay if you have a claim, and you got to communicate that to your owners, because some states, whoever benefits pays those deductibles, and they can buy, as a homeowner, I have to pay the first $50,000 of a claim, but I can buy on my HO6 personal property insurance policy. It'll cover me. It'll pay that large association deductible. But we also need to remember, go read the CC&Rs, because you might have a cap on the amount that requires notice, at least like the one example we saw, or it's just a hard cap. You can't go above that without doing an amendment to your CC&Rs to do that. So, and it's a pretty easy sell for owners when you say, okay, our insurance for our property with a $10,000 deductible is $500,000 a year, but if you go a $50,000 deductible, it's $212,000 a year, right? People are going to see that cost and make that risk, and but make sure you have the authority to do it. Anything else out there?
Not seeing anything else. We really much appreciate everybody attending today. Oh, we just got a hand raised. Ramon, let's see if we can find you on our list here. There we go.
Ramon, welcome. What's your question? You're muted. Now you're unmuted.
Let's say that you have a damage, like a leak or something like that on the roof, and it's not covered, right? Or it's excluded. So how do you handle that damage? Who's supposed to pay and how much?
Yeah, most roof leaks should be covered in a standard policy unless it's been specifically excluded for some reason. So here's the questions, right? Is the roof association common area, or is the roof the personal property of the person who lives beneath the roof? And so if it's common area, board members, you need to have a policy that says this is how we're handling roof leaks. You should have a policy either way, regardless of whose responsibility. The biggest thing is people, they don't think about it ahead of time. A claim happens, the roof leaks. Now I have thousands of dollars of damage inside of my unit. And I just never knew that it was my responsibility. Well, associations, be proactive, put together flyers and communication so everyone understands, because even if the association's policy is not covering it, your personal property policy probably will cover it. So I hope that helps.
Yeah, let me be more specific. In our HOA, the association is responsible for maintaining, repairing, and replacing the roofs. So what happens if you have a leak that is due to
yeah, and the state, what state are you in, Ramon?
Utah.
Okay, in Utah, the law says that even if it's an association roof, you have the damage inside of your unit, you pay the deductible on that claim. Now, your personal property insurance will pay that deductible for you, and they might say, and say it's farmer's insurance, which for a personal property policy is fine, not for an association policy, for a personal property. They're going to go back and say, well, why does Ramon have this $25,000 claim? It's because the association roofer did a poor job, or the association hasn't maintained it. And your insurance might go fight that battle to get that money back. But just remember, just because state statutes allow something doesn't mean associations have to accept or pass on that liability. You can always, associations provide more coverage than the state allows. States are like minimum. So sounds like you might be in a situation like that, Ramon. I'm glad to, if you would like, send an email through to the registration, and we can have someone get a hold of you and talk about your specific example.
Appreciate it.
Thanks, Ramon. Anything else, Neil?
Awesome. There's Kathy. Let me find Kathy and let you unmute yourself. Okay. Kathy, you should be good to press unmute if you still have a question.
Maybe Kathy was just waving hello.
Maybe just a hello. Well, thank you all.
And Kathy, if you have something, please get a hold of us offline. We'd love to answer your question. All right. Next time in 3 weeks, I believe from today, RFPs and contract business partners, November 15th. I imagine Mr. Neil will be one of our primary presenters that day, or knows who they are because it's not me. And or maybe it is me and we need to have a meeting. All right, everyone, have a great fall, a happy Halloween. I hope your teams are in the World Series and your football teams are always winning. Mine are not. So but yet we go on. We appreciate you, and thanks for joining us today.